Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields still holding the range. Came very close to touching that 3% upper bound of the range since May 29th. That 3% to 275 range we've seen, we remained in it and we backed off slightly today. The same event occurred last month. Following the 3, 10, and 30-year auctions, we saw the market actually rally a little bit, and I think that we saw much of the same today. There were some better auctions in the longer end of the curve, especially the 10-year auction. So right now the market seemingly, fading that upper 3% as it has several times before, very similar to the way it faded the 280, 275 level when it got down there. So market holding that range, not showing any signs of breaking out, although we got very close to it. And as you can expect, when volatility, we got close to that range, volatility was holding steady. We back off that outer bound and volatility got crushed, nearing year-to-date lows in the Treasury sector, which isn't a surprise. However, with how low it is going, it seems like with all that's happening in the world, when you talk about trade with China, when you talk about emerging markets and currency and credit issues, when you talk about potential from the Fed or inflation or Europe or something, there's a lot of variables out there that could be pushing volatility higher, and it is not. So that inherent central bank put protection, whatever you want to call it, seemingly keeping the market at bay as equities go higher, Treasuries hold their range. And lastly, as we look at the market, we've got a key focus looking ahead. It's FOMC, September FOMC. That is going to be our focus. However, the market is loaded up on its shorts again. Ahead of last week's non-farm payroll number, the net shorts from the leveraged fund community, which is the hedge funds, they exited some of their shorts, a significant portion, but then they re-entered them ahead of non-farm payroll. And that to me suggests that the market really is looking for a breakout to the upside in yield, whether it come be a news, whether it be a demand, or however, whether it comes from the Fed. A lot of what we're seeing here correlates with higher yields, and we just haven't seen them over the course of, going back really to the end of May when we saw things bottom out. So right now, the market positioned for higher yields, and it's not getting them. Typically, when we see everybody on the same side of the boat, that side of the boat is not rewarded handily, at least not right away. But the shorts we've seen in the Treasury sector have been huge and for quite a long time, and they have not been rewarded. Likewise, we see the same in Eurodollar futures. We see heavy amounts of shorts waiting for rates to go higher, and it just hasn't happened yet. So right now, we continue to see shorts and shorts initiated, yields not going higher, and a lot of uncertainty out there with no volatility. It doesn't make for a recipe for things to end well. And I think right now we're going to see a moderate move back to the center of that range down near 290, at least until we get to SEP FOMC, and then some questions may be answered. This is Todd Colvin coming to you from the floor of the CME Group.